Hey everyone, and welcome to this explainer. Today, we're diving into a topic that sits at the absolute heart of modern accounting and finance, yet somehow it often feels completely shrouded in mystery. We're talking about IFRS 13, fair value measurement. But don't worry, we're going to break down this highly complex standard into a clear, highly visual framework. Look, let's be honest right out of the gate. The raw regulatory text for these accounting standards is, well, it's incredibly intimidating. It's dry, it's dense, and it is definitely not light reading. It looks like a giant, impenetrable wall of text. But our mission today is to cut right through that noise and translate the jargon into something that actually makes sense.
Because really, it all boils down to one incredibly simple yet maddeningly complex question. What is an asset actually worth? Or a liability, for that matter? When you can't just easily look up an observable market transaction, how in the world do accountants estimate a price that is fair, consistent, and totally transparent? To unpack this, we're going to hit 5 key stops today. First, defining fair value. Second, markets and market participants. Third, highest and best use. Fourth, 3 valuation techniques. And finally, the fair value hierarchy. Let's get right into it.
Section 1. Defining fair value.
So, according to the standard itself, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. I know, that's a mouthful. But I want you to laser focus on the phrase price received to sell. Fair value is strictly a market-based measurement, not an entity-specific one, and it assumes an orderly transaction, meaning this isn't some chaotic forced liquidation or a distressed sale. The market has actually had time to properly process it.
To really cement this, think about the huge difference between an entry price and an exit price. An entry price is what you pay to acquire an asset. An exit price is what you receive to sell it. IFRS 13 dictates that fair value is always the exit price. Think of it like a used car, right? The price you paid the dealer when you bought it, your entry price, might not be the exact same amount you'd receive if you turned around and sold it to someone else the very next day. That next day price is your exit price, and fair value only cares about that exit price under our current market conditions.
Section 2, markets and market participants.
So, where is this hypothetical transaction actually taking place? The standard tells us to look first for the principal market. Simply put, that's the market with the greatest volume and level of activity for that specific asset or liability. That has to be your primary assumption. But what if there isn't a clear principal market? Well, in that case, an entity looks for the most advantageous market. This is the market that maximizes the amount you'd receive to sell the asset, after you factor in transport and transaction costs. But keep in mind, if a principal market does exist, you literally have to use the price in that market, even if another market out there offers you a slightly better price. And who exactly is doing the trading here? The standard outlines some very specific criteria for these market participants. First, they must be completely independent of each other, so no insider-related party deals. They also have to be knowledgeable, having a reasonable understanding of the asset using all the available information. And crucially, they must be both able and willing to enter the transaction. We're talking about highly motivated actors acting in their own economic best interest, but again, they are absolutely not forced or compelled to make the trade.
All right, Section 3, highest and best use. When you're dealing with a non-financial asset, think a piece of land or a big factory, you have to assume a market participant is going to maximize its economic benefit. But it's not the Wild West. You can't just dream up any use case. The highest and best use has to hit 3 very strict rules. It must be physically possible, given the size and location. It has to be legally permissible, meaning you absolutely have to factor in local zoning regulations. And it must be financially feasible, meaning it actually generates an adequate return. So if you own a plot of land that's currently a farm, but it's legally zoned for commercial development and a market participant would build a shopping mall there to maximize value, you measure the fair value assuming the mall development, not the farm.
Section 4. 3 valuation techniques. So how do accountants actually figure these prices out? Well, IFRS 13 provides a toolkit with 3 main approaches. First up is the market approach, which uses prices generated by actual market transactions for identical or comparable assets. Second, we have the cost approach. This reflects the amount required right now to replace the service capacity of an asset, so think of it as the current replacement cost, properly adjusted for any physical or technological obsolescence.
Finally, there's the income approach, which converts future amounts, like expected cash flows, into a single discounted present value. And what's kind of fascinating is that an entity doesn't have to just pick one. Very often, multiple techniques are used together to map out a reasonable range of values and pinpoint the exact spot most representative of fair value.
And finally, Section 5, the fair value hierarchy.
Now, before we step down through the hierarchy itself, we really need to understand its guiding principle. The absolute golden rule of IFRS 13 is that you must maximize the use of relevant observable inputs and minimize the use of unobservable inputs. Basically, the standard demands hard, undeniable market evidence over internal management estimates whenever possible. To enforce this, IFRS 13 categorizes inputs into 3 descending levels of reliability. Let's walk down that staircase together. Right at the very top, we have Level 1 inputs. This is the gold standard, folks. Level 1 inputs are totally unadjusted, quoted prices in active markets for identical assets or liabilities that the entity can readily access at the measurement date. If you own a share of a publicly traded company and you just look up the closing price on the London Stock Exchange, that is a Level 1 input. It provides the absolute most reliable evidence of fair value, and honestly, if it's available, you are required to use it without any adjustments. Stepping down a tier, we hit Level 2 inputs. Think of this as the middle ground. These are inputs other than those perfect Level 1 quoted prices, but they are still observable for the asset or liability. This could be a quoted price for a similar asset in an active market, or maybe a price for an identical asset but in an inactive market. It also includes market data like interest rates, credit spreads, and yield curves. So you're still looking outward at the market, but you might have to make a few specific adjustments to fit your exact asset. And then we reach the bottom of the hierarchy, Level 3 inputs. These are completely unobservable inputs. You end up in Level 3 territory when there is little to literally zero market activity for the asset or liability at the time of measurement. Here, an entity essentially has to build its own inputs using the best internal information available. But, and this is a really crucial point, even down in Level 3, the ultimate objective is still to find an exit price, so the entity has to adjust its own data to reflect the assumptions that actual market participants would use, including risk assumptions. Because this level relies so heavily on internal models and management forecasts, Level 3 absolutely represents the highest degree of measurement uncertainty. Now, because Level 3 is swimming in so much subjectivity, IFRS 13 demands a massive amount of transparency. That brings us to disclosures. The standard requires extensive disclosures, especially for these Level 3 measurements. Companies literally have to reveal the valuation techniques they used, the quantitative inputs, and even provide a full reconciliation of opening and closing balances. This isn't just boring, bureaucratic red tape. It is a critical transparency tool. It gives everyday investors the clear window they need to assess exactly how those fair value numbers were cooked up and how much subjectivity is actually baked into them. Which brings us to one final, really important thought to chew on. If a company's balance sheet is heavily propped up by these Level 3, completely unobservable inputs, how much do you actually trust their reported numbers? You see, understanding IFRS 13 isn't just some dry accounting exercise. It's about fundamentally understanding the nature of financial trust and transparency in our global markets. The next time you look at what an asset is supposedly worth, you now know exactly what level of reality or assumption that number is built upon. Thanks so much for joining me on this deep dive into the standard. Keep questioning those numbers, and I'll see you in the next explainer.